The Lal Street takes a cue from the global markets to end Friday higher. The Nifty and the Sensex for the week, however, end lower. Hello and welcome to another episode of Editors Roundtable. I am Reema Tendulkar. With me is Prashant, Nimesh and Nigel. Hi, guys.
Hi, Reema. I mean, it's been an exhausting week.
It was an important one, right? Earnings, the US CPI, and we spoke so much about the US CPI, I think as much as the US anchors, I think.
But you know, Reema, among all the noise, in Nifty is only up or down 1%. You know, I mean, you swing like 500 points, but net, if you look from last Friday to this Friday, we're just down 1%.
And it's still respecting the range, the broad range that we've been holding on to for so long.
By the way, talking of exhaustion, I don't think any of us should complain. Because
I was just going to say that. I was like, Prashant's taking it away.
You know, we were talking earlier in Closing Bell that Reema starts the earnings season with IT, and Nigel wraps it up with
metals.
Right?
I mean, slow off the blocks, but then after that, Reema's chilling, and you know, I'm playing catch up.
So what does that make you and you? And the opening.
We're backbenchers.
Calling the shots. Calling the shots.
I think that's more appropriate. But let's take stock of the market.
Yeah, I mean, as Nimesh said, I don't think very much happened. I mean, a lot happened, but if you analyze it point to point, Friday to Friday, not very much at all. You know, the range for the market on the Nifty remains the same, which is 16,950, which has been, you know, the low for 4 days in a row now. Today and the 3 days prior, 16,950, round about there. And on the upside, I mean, the level has been about 17,300. You want to quibble, it's about 17,262 or so. That broad range has not been kind of taken out. We've been there for almost a fortnight now, despite all the up and down that we've seen. Your sector, IT, has done well for the second week in a row. It was up 3%. It's up another percent this week. Banks, especially private banks, I mean, they're keeping up to the promise. You saw numbers from Federal Bank. We'll get numbers from HDFC, etc. You know, that index has done well. It's up almost 0.75% for the week. The rest of it is, of course, global, right? I mean, because this gyration that we are seeing is because there is no clarity when this entire global turmoil, global macro issue is going to resolve. So the market rallied big time in the US on Thursday. And I think follow through is important because I think that is what everybody's watching, whether it was just a one-day wonder or, you know, it's got more legs to run. And in that sense, I mean, if there is more legs to run, it basically provides fuel to the fire here. Not as if we need very much help because, I mean, the market's been running ahead when US does well and falling less when the US falls. So it's outperforming, but I think it'll just kind of add a little bit. There is one more interesting thing, actually two more. In the UK, again, I mean, just crazy markets we live in, right? The tax cuts which happened, the collapse in the currency, 2 weeks of all of it, and now apparently the tax cuts are being rolled back. So, I mean, it's just, you know, you wonder what's going on. And then on Sunday, you've got this big political event in China, and we'll see if something comes out of it. We'll present something later on the program there. But Nimesh, what are you picking up?
You know, Prashant, someone very senior very nicely, you know, summed up the markets, the recent market moves. You know, it's like liquid oxygen. Bears तुम्हें जीने नहीं देंगे और bulls तुम्हें मरने नहीं देंगे. That's been the kind of the market, right? 16,950 very well getting defended. 17,400 very strong resistance. We've been in that range. But surprisingly, you know, for the first, I mean, after 2 months, we are seeing a bit of net outflows from the FIs. So that's a bit something to watch out for. You know, it looks like there's a bit of exhaustion as well. FIs don't seem to be buying back and not supporting the market. So that's the overall flow point of view. Even, you know, it clearly looks like there is a tug of war between the bulls and the bears. One big, large FI brokerage putting out two different views. One was a bull view and one was a bear view. The bear view was a technical view and the bull view was like, oh, we are going to see a big, you know, rally from here on, and S&P will rally 17%. So there is a lot of confusion within the market participants as well. And as you rightly pointed out, you know, this week I don't think like anybody has made money. I mean, it's like you've been in the market, but you don't know which way to move. 200 points up, 200 points down, gap up, gap down, and really not making much sense. The fact that, you know, look at the CPI data, and it clearly says that another 275 basis points are lined up, and still markets are like, oh, you know, it's trying to ignore the global data. So that's the kind of market, you know, not here, not there, not much happening as well. So I guess that's going to be the big thing to watch out. I guess from a micro point of view, earnings are going to set the tone, and which is we have already seen it happening in the IT names. Reema will sum up for us. But clearly, that's going to be the trend. You know, we have HDFC Bank tomorrow. We've got large numbers reporting next week. So I guess micros will take center stage, you know, because most of the global events are out of the way. But again, you know, there is no direction coming in either from the larger HNIs who are the smart investors, so to speak, or from the FIs as well, because even they've been quite absent this week. So I guess, Rima, you tell us, 1 week of YT, some large numbers have come out. What has been your key takeaway as to how to map these numbers?
Well, for starters, the Nifty IT index and the stocks are showing some signs of rebound, right? This week, the Nifty IT index was up 0.7%. This month, that's in the last 2 weeks, it's rallied close to about 3.5%. The good news is technically we appear poised for a bigger rebound. Now, let me tell you why. Now, this year, we've seen 3 negative returns for 3 consecutive quarters, which means a negative return on the Nifty IT index for the March quarter, then June quarter, and then in the September quarter. In the last 22 years, that's since 2005, there has been no instance of a negative return for 4 consecutive quarters. There was in one case in 2011 when the Nifty IT had given you a negative quarterly return for 3 consecutive quarters. Again, very similar to what we saw this year. A decline in the March quarter, a decline in the June quarter, and a decline in the September quarter of 2011. The Nifty IT index in 2011, in those 3 quarters, had declined close to about 24%, but then it rebounded in the subsequent 2 quarters. And right now, what we're seeing appears to be very similar to 2011. So if we're following the same template, then perhaps technically we're poised for a rebound. Now, quickly, let me run you through what the read-through from the IT sector earnings is, because this week we had earnings from all the 4 large cap companies. One, it was not as bad as what the street was fearing. The revenue growth numbers are up for you on your screen. They were largely in line. It's a good 4% quarter-on-quarter revenue growth. 3 out of the 4 large cap IT companies have reported a margin expansion, a significant margin expansion, and a margin beat. All of them, ex of Wipro. In fact, HCL Tech saw fairly decent upgrades as well in terms of its earnings. Also, the FY23 guidance tells us all is well, at least for now, right? The next 2 quarters are protected in terms of the revenue growth. That said, there is a risk, right? Q3, 4, the data that we have up until now, fundamental, is all past data, is right? Yeah. It ends in September. There is always a risk what happens in Europe in winter and the gas crisis, etc. So Q3 furloughs may be far more than what the street is anticipating. Look at what the companies are talking about, the sectors which are under stress, so growth is moderating. TCS called out insurance. Wipro called out technology companies, which means you're large, the Microsoft, Amazon. No one takes names, but just to tell you what technology over there. Infosys spoke about caution in high-tech and telecom. Mindtree spoke about in retail, communication, media, and technology. So we're not out of the woods, right? And that said, we have absolutely no visibility from any of the managements about FY24. So while there has been a significant PED rating, which puts us perhaps in a good place, but there is no visibility, right? We can just talk about the here and now. But let's...
just to add to your point, Rima, the positioning of the FIs is also underweight on IT. So, if you see a surprise, you're going to see a bit of chase in these stocks. That's been the trend. For the last 2 or 3 quarters, FIs have been constantly selling the IT index, the IT stocks. So there is a bit of under ownership in the IT name. So in case there is a big outperformance or even a bit of a small surprise, you're going to see a bit of outperformance on those stocks. Yeah. So I think that's something...
The ownership was light and the expectations were very low.
Very low.
So it's a combination of these 2.
Exactly. So from that point of view, even a small surprise will mean, what we saw today in HCL Tech or maybe in Mindtree or in some
or even in Infosys.
Exactly.
Matter,
so that's something to watch out for from a near-term positioning point of view.
Yeah, I think just one more point on the FIs. In the last 1 year or so, I think the FIs have net sold close to $28 billion in the Indian markets, and out of that, close to 40% is accounted for by the IT names itself. IT
and financials, because they are the two biggest, largest weights. So.
Okay, let's zoom out a bit. We've spoken about the current quarter, the outlook for the next quarter. What about the last decade?
Well, I just wanted to put something on the table. The last decade has belonged to the lenders. The question that I'm asking is, will the next decade belong to some of the savers? So let me put it into context then. We had Mr. KK Mistry. He joined in here on CNBC-TV18, and he said that if you're looking at, mortgage to GDP as a ratio, it's moved to around 11%, though he believes that it's still very much under-penetrated here in India. So I said, let's do a little bit of a recap. Well, around 15 years ago, it was only around 6%. So that number has gradually moved up. And yet he says that it's under-penetrated. The big money, remember, has been made in the lenders in the last decade or so. And some of those stocks should come up for you. Big returns is what you have seen on the lending side of things. The question is, will the next decade or next couple of decades belong to the savers? So let's put that into context then. Life insurance as a sector, as a percentage of the total number of people insured, well, that's very, very low. It's still at around the 2.5 to around 3%. Moving to health insurance, there are 3 big points out here. number of lives that are covered under retail health insurance, it's still only around 3.5% odd, and it's expected to go, say, to around 5% in the next 2 to 3 years odd. The second point is out-of-pocket expenditure. That is when you get hospitalized, out of the 100 rupees that are spent, in India, closer to around 70 rupees is out of your own pocket. Only the smaller part, it comes in from insurance, while globally, only 20 rupees is from your own pocket, while the remainder comes in for insurance. So that's telling you that health insurance as well is under-penetrated. And finally, health insurance expenditure as a percentage of GDP, well, it's still relatively lower if you compare it with the globe. The other point is the equity cult here in India. We've been talking about this quite a few times as well, and we have 50 crore, PAN cards in India. But the mutual fund, industry, the reach is only around 3.5 crores. This is the data point that I pulled out from HDFC AMC, their annual report. The other point is from the Nippon AMC annual report. They as well mentioned that equity mutual fund AUM as a percentage of GDP, to that ratio, that as well is much lower in comparison to the rest of the globe. Finally, how do you approach it? If the next decade is going to be belonging to the savers, then life insurance stocks with their valuations up for you. Star Health Insurance, that's the only listed company in there. So if the health insurance sector has to do well, that could possibly be one sector that you're looking at. And besides that, if there's going to be an equity cult that's going to be developing as well, then a lot of other stocks as well should be in focus, whether it's those AMCs, depositories, or maybe aggregators as well. Some of the evaluations as well come up for you. And remember, on a near-term earnings, some of them look expensive. But if things are going to be improving, then in fact, the valuations will catch up. So that's the big theme. Last decade to the lenders. The coming decade, will it belong to the savers? Back to you guys.
Very interesting, Nigel, but it's time now for a very short break. We'll be back with opinion coming in from Paul Schult of Schult Research. Stay tuned. Welcome back to Editors Roundtable. Anuj has also now joined us on the show. Anuj, just before the break, Nimesh was telling us how we've seen a pickup in FI selling, and there now appears to be a pretty tense battle between the FIs and DIIs. What's the data telling you?
Actually, between FII and retail, Rima, which is the battle that I'm focusing on, and it's like the classical David versus Goliath, right? Favorite versus the underdog. The good news is, and I'll tell you the good news. First of all, look at the data point. The FI short position in India right now is at record high. But for every long, there's a short. Or every short, there's a long, right? Because the net open interest will be zero. So who's long versus this FI? If FI is shorting so much, if FI is 80% short, then who's buying this? It's retail. FIs are short by 1.15 lakh contracts. Retail is long by 1.6 lakh contracts. Now to the good news. This has happened 3 times in the past. And what's been the score line? 3-0 to retail. Retail has won every time. It's actually trumped FII every time on this F&O data. The last time this happened was actually in June 2022, when the Nifty rallied 15% over a 2-month period, when retail was this much long and FII was this much short. Previously, when was FII net short and retail net long in the market? March 2020, the Nifty rallied 20% in 2-month period. And before that, April 2018 is when FIs had more shorts than retail had long. Nifty rallied 10% over the next 2 months. If I were to stick my neck out, I would say that this time as well, it should be the retail because, the Indian markets got its own factors going for it. And the way the market's been taking support consistently at the 200-day moving average, it's advantage retail.
And the retail bit that you say, the NSE classifies it as client, right?
Client, yes.
And that client could include not just retail, HNI, family. So you can actually call it smart money as well.
Absolutely. I mean, the point here is that the local money, which is individual money, let me put it this way, we classified retail, but why call it dumb money? It is actually the smart money.
It is the smart money.
But Prashant, what about China? I mean, can that...
from US to China, I mean... So I'm going to focus on what's happening there on Sunday, this Sunday. Let me actually head across to the big wall. So this is basically, I don't know if all eyes are on China, but I think many will be watching this closely for a very simple reason. The 20th Party Congress, when I say party, it's the Communist Party of China, which is the most important sort of political entity in China, which is having its 20th Congress. It starts on Sunday. It's not a one-day event. It starts on Sunday. 2,300 delegates will attend and elect what is called the Central Committee, which is the Politburo. And of course, its standing committee as well. On Sunday, though, we will hear from President Xi Jinping, who will deliver the political report. He'll take stock of what has happened, and then he will lay out the focus and key policy areas for the next 5 years. So the new Politburo, the new Central Committee, which basically is made up of all the top government functions, the topmost ministers in China, that will be elected for the next 5 years. This will happen after the Congress ends. I mean, there's a meeting which is held at the newly elected Central Committee, and they then elect the General Secretary, etc. This is the schedule. So Sunday is, of course, the speech from the President, Xi Jinping, the current president. The Congress mostly lasts for 7 days, which means that the event gets over on the 22nd. And on the 23rd is the election of the Politburo. One widely anticipated thing is that we will see the reappointment of Xi Jinping for the third time. I mean, some are saying that he'll basically become president for life. We'll see. There are also some other reports which indicate that his status will be elevated. You know, he's the core leader. From core leader, he will become the people's leader. Now, that is a title which was last reserved for Mao Zedong. We'll see if Xi Jinping actually gets that title as well, which basically means that he's got complete control of what's happening in China. Why is this important? Why do we bother with this from a market standpoint? China is seeing some of its slowest pace of growth in decades right now, right? And China is a big consumer and, of course, a big spender of global economy. It carries weight, and it's not carrying its weight right now because of the slowdown. The other point is China's zero COVID policy. Will we see a shift from zero COVID to some tolerance level here, which means opening up of the economy, etc.? Will we see an indication of that in the speech? Reprioritize growth. I think I already talked about this. Property sector has been bleeding. The mantra in China has been properties for living, not for speculating. Will we see some change and more support to the property sector? And of course, we've seen a 2-year-long crackdown on tech platforms in China. Will that ease up? Basically, more focus on economy. I'm not getting into the other stuff, which is foreign policy, etc., which I think many will watch very closely as well. But I think we've got, Paul Schult joining us now of Schult Research. Paul, great to have you with us here. Thank you very much. We've spoken about China before, but now ahead of this event, how significant is this, according to you, or you think it's going to be not very important and we'll see more of the same? What's your sense?
I think everything's baked in the cake. There's not going to be any surprises. I think everyone knows what's going on. We know what the outcome's going to be. What is interesting to me is what happened this week from the point of view of the U.S. In the U.S., basically, we have had 3 body blows to China in really 72 hours. You've had the first one, which was that the U.S. is going to ban all semiconductors predicated on permits from the central government in Washington. Number 2, you have had a ban on all products from Huawei and ZTE. And number 3, and very importantly, Australia, along with the West, basically rejected China's entrance into this new TPP trade agreement. And so you've had a big body blow in terms of trade in America, technology access to inside China, and a global trade agreement rejection by Australia. And so, going into this politically charged environment, it's very tough to maneuver right now, and I'm sure China is infuriated by this.
Paul,
it's all very negative. It's all very negative. Yeah.
It's all very negative. What about the U.S.? Are we at the cusp of a big rally in U.S. markets, Paul?
Yeah, I've been pretty negative on your show the last couple of months, and it's been a really hard, awful, dreadful time. And I'm going to tell you, I feel much more positive. I think the damage to, if you talk to fixed income credit people, they're tremendously worried, much more so than the equity people are, because they see the credit markets and the fixed income markets sort of falling apart. And we're very close to sort of going over the waterfall in terms of liquidity, certainly in the UK, possibly in US Treasuries. You saw the warning by Yellen just last night, warning the Fed about liquidity problems in the Treasury market. I think the Fed can say, look, at inflation's high. We're going to pause. We need to just look at things. You don't want to, England is America's closest partner. And the British, gilt market is on the verge of collapsing. So they're going to have to pull back here. I'm convinced. And I think there's going to be a very big rally.
Paul, what about the emerging markets? Because India in particular has really managed to stand out as an outperformer.
Yeah, exactly. So the last time I was with you, I just said that, that old Rudyard Kipling, if you can keep your head when all about you are losing yours, you're losing theirs, you're in good shape. And so Russia remains closed. China is a mess. South Africa is sort of, hands off. Brazil is going through a very tricky election. And so, right, India is the last man standing of the BRICS, literally, right? I mean, these other countries, Russia's going to be even more shut down now after what they did on Monday in Kiev. And I think China is going to be more shut down after what the U.S. did. And I think South Africa is problematic. And I think Brazil is also problematic. And so the opportunities are very limited. And I think now that if the Fed can hold off, the dollar will weaken a little bit. And you'll get some oxygen put into the room of these emerging markets, and you won't have so much downward pressure on the rupee. I think that's what's going to happen.
Paul, great insights, but unfortunately we're out of time. A big thank you from the entire team of CNBC TV 18 and wish everyone a fabulous weekend.